Welcome to Page by Page, the podcast where we unpack the latest analysis from the world of finance. Today, we're diving into the August 8th, 2025 issue of Value Line's Selection and Opinion Report. The key theme emerging from this issue is cautious optimism in turbulent times. We see a market wrestling with restrictive Fed policy and tariff impacts, yet finding strength in solid corporate earnings. We'll break down Value Line's take on the broad economy, look at how their model portfolios are navigating this environment, and highlight some specific stock screens for investors trying to find opportunity amidst the uncertainty. So, let's get into it. Value Line begins with a look at the big picture, and the main character in this story is the Federal Reserve. The Fed has pressed pause for the fifth consecutive meeting, holding the federal funds rate steady in the 4.25% to 4.50% range. Why the pause? In a nutshell, the central bank is waiting to see the fallout from the Trump tariffs and their impact on inflation. The Fed is in a tricky position. One part of its dual mandate, full employment, seems to be in good shape, with the unemployment rate at a low 4.1%. But the other part, price stability, remains a challenge. Inflation is still running above the Fed's 2.0% target, and officials believe the full effect of the tariffs won't even be felt until late summer or early fall. But while the Fed is cautiously waiting on the sidelines, corporate America has been delivering. Second quarter earnings season has been surprisingly strong. As of the report's press time, with over a third of S&P 500 companies reporting, a remarkable 80% had beaten both revenue and profit estimates. This earnings strength has given a real boost to the stock market. So Value Line's overall conclusion is a balanced one. Stocks performed well in July, thanks to those strong earnings and some positive trade news with Japan and the EU. However, with monetary policy still restrictive and valuations looking stretched, the report advises that some caution may be warranted. So how does this high-level view translate into actual investment strategy? Value Line gives us a peek under the hood with its 4 model portfolios, and the recent company reports reveal a very mixed bag. The contrast between corporate fortunes is especially clear in Portfolio 3, which is designed for long-term growth. On one hand, you have Alphabet, the parent company of Google. It posted better-than-expected results, with revenues jumping past $96 billion. The real story was the engine behind that growth. Its cloud computing division saw revenue soar 32%, and even its core advertising business climbed over 10% despite economic uncertainty. But in that same portfolio, you have the pharmaceutical giant Merck, which told a very different story. The company struggled, reporting disappointing earnings. The most shocking number was a massive 55% decline in sales of its HPV drug, Gardasil, due to plummeting demand in China. We're also seeing major corporate actions shake up the portfolios. In Portfolio 2, which focuses on income, the regional bank Synovus announced an all-stock merger with Pinnacle Financial Partners. The market reaction was brutal. Synovus shares fell more than 10% after the announcement, prompting Value Line to downgrade the stock to a hold. And finally, that macro theme of tariffs keeps popping up. Genuine Parts, a holding in Portfolio 4, reported decent results, but the company explicitly warned investors that the implementation of trade tariffs could weigh on business later this year. It's a direct link showing how the economic headwinds discussed on page 1 are a direct threat to individual companies. For investors looking to build their own portfolio, Value Line also runs several screens to identify stocks that meet specific criteria. This issue highlights 2 interesting approaches for a risk-averse environment. The first is a screen for low-risk stocks for worthwhile total return. The criteria here are straightforward but strict. The screen looks for stocks with an above-average safety rank of 2 or better, high projected price appreciation of at least 45%, and a current dividend yield of at least 2.6%. The goal is to find safe, stable companies that still offer a good shot at capital gains and income. Big familiar names like Comcast, Merck, and Nestle all made this list. The second screen seeks out low-risk stocks with high return on equity. The logic here is to find safe companies that are also incredibly efficient at generating profit from their shareholders' money. This screen is dominated by what you might call quality champions, like Illinois Tool Works, Visa, and ADP. Interestingly, ValueLine notes that most of the stocks on this list are trading at a premium valuation, suggesting that in the current climate, investors are willing to pay a higher price for the perceived safety and profitability these companies offer. Finally, ValueLine introduces a new company to its coverage, Alphatec Holdings, a small-cap medical technology firm with the ticker ATEC. Alphatec is a fast-growing company that's focused on one thing: improving the surgical treatment of spinal disorders. The market opportunity here is significant. As ValueLine points out, about 25 to 30% of patients who undergo surgery for a spinal deformity need another operation within 5 years. That's a shockingly high revision rate, and Alphatec is betting its advanced imaging and information systems can help solve the problem. But this is a high-risk, high-reward play. The company is not yet profitable, and it's a small fish in a huge pond, competing against giants like Johnson & Johnson and Medtronic. ValueLine's take is that the company's sharp focus could result in market-beating returns over the long run, and it might even be a prime target for acquisition by one of its larger rivals. So the picture from ValueLine is clear. It's a market propped up by strong corporate performance, but threatened by persistent inflation and the unpredictable effects of trade policy. The advice is to be selective, focusing on quality, safety, and genuine long-term growth stories. Coming up next, we'll step back and offer our own take on this landscape, reading between the lines of the analysis. Stay tuned.
We've just walked through the key findings from ValueLine's August 8th report. Now, we're going to respond to the conversation by offering a more critical perspective, looking beyond the data to discuss the bigger stories at play. The first and most important story is the elephant in the room, the Trump tariffs. ValueLine's report is, by design, objective. It states is a fact that the Federal Reserve is pausing to assess the impact of these tariffs. But let's be clear about what this really means. This isn't just another economic variable like consumer spending or housing starts. It's a fundamental source of manufactured uncertainty. While ValueLine notes the Fed is pausing to assess, the deeper story is that the central bank's entire policy path is being held hostage by political decisions. The report calmly mentions that Fed leaders expect the tariff impact to become more notable in the late summer or early fall months. For an economist, that's an observation. For a business owner, it's a ticking bomb. We see the anxiety playing out in the company reports. Genuine Parts directly warns its investors that tariffs could hurt business. Merck's disaster in China, where sales of a key drug fell 55%, may not be a direct result of a specific tariff, but it highlights the extreme vulnerability of global sales channels in the current geopolitical environment. The tariffs are a symptom of a much larger, politically driven realignment of global trade, and ValueLine is documenting the economic consequences in real time. This brings me to my second point. Is the market's idea of safety just an illusion? A huge focus of this ValueLine issue is on finding low-risk stocks. The screens are built on classic, time-tested metrics, a strong balance sheet, a history of stability, and consistent profitability. But the question we should be asking is whether the definition of risk itself has changed. A company like Nestle appears on the low-risk total return screen, and it seems like the textbook definition of a safe investment. But in a world of escalating trade wars and economic nationalism, a massive multinational corporation has a global footprint that makes it vulnerable everywhere. Its supply chains, its currency exposure, and its reliance on stable international relations are all potential points of failure that a traditional safety ranking might not fully capture. Consider the screen for low-risk stocks with high return on equity. ValueLine makes the crucial observation that investors are paying a premium for these stocks. This is a classic flight to quality. But what if that quality is based on past performance in a world that no longer exists? A high return on equity is a backward-looking metric. The rest of the report is filled with forward-looking threats. It feels like driving by looking only in the rearview mirror. The biggest risk for a company today might not be its debt-to-equity ratio, but its geopolitical exposure. Finally, when you read through the individual company updates, you can't help but notice a great divide opening up in the corporate landscape. The report paints a clear picture of a two-track economy. On the first track, you have the digital powerhouses. Alphabet is a prime example. It's not just growing, it's investing aggressively for the future, pouring another $10 billion into capital spending to stay ahead in the AI race. These are companies that are thriving because they control intangible assets, data, platforms, and software. On the second, slower track, you have the old economy companies that deal in physical goods. The steelmaker Nucor is forecasting lower earnings for the next quarter. The drug maker Merck is getting hammered by its operations in China and is now launching a major restructuring to cut costs. Value Line's job is to analyze these companies one by one, but the bigger picture is one of an accelerating divergence. The digital economy seems to be playing by a different set of rules, far less constrained by the cross-border trade and supply chain problems that are plaguing the industrial and healthcare giants. This isn't just a collection of random earnings reports, it's evidence that the very nature of what creates economic value is shifting before our eyes. So, what's the big takeaway when we read between the lines of Value Line? While the report offers a steady, data-driven guide for investors, the world it describes is anything but steady. There's a profound tension here. We see a Federal Reserve sidelined by political decisions, a market that's rewarding past safety even as new forms of risk emerge, and a corporate world cleaving in two. The real story isn't just about finding the next winning stock. It's about understanding that the fundamental rules of the game, from global trade to the definition of a safe asset, are being rewritten. The challenge for investors isn't just navigating the market, it's navigating this paradigm shift. That's our take on this week's Value Line report. We encourage you to like and subscribe, and leave your thoughts down below. Thanks for listening to Page by Page, and we'll be back next time with another deep dive.